Welcome, everyone, to our webinar on Unigestion's macro views. I'm Ken Ebling, and I'm joined by two of my colleagues from our cross-asset solutions team, Florian Ielpo, our head of macro research.
Hi, Ken. Hi, everyone.
Hey, Florian. And Salman Beg, one of our global macro PMs.
Hey, Ken. Hi, everyone.
What's going on, Salman? Before we start, I just want to quickly run through some logistics. Florian and Salman will walk you through a handful of slides, during which you can ask questions by using the text box on your screen. We'll take some time towards the end to answer as many as we can, but if we don't get to your question today, we'll be sure to follow up afterwards. And of course, if you have additional questions following the webinar, please don't hesitate to reach out to your business development contact, and we'll be sure to get back to you. With that said, we've generally seen equity markets continuing to rally since bottoming out in late March. An obvious but still relevant point is that the pace of this recovery has been significantly faster than what we saw in 2008 or 2001. Clearly, a major driver of this has been the stimulus we've seen from fiscal and monetary policy. And given that we may see even more stimulus, I think many investors are asking the same questions. Can this continue? And if so, how much higher can markets go? So Florian, maybe we can start with you. How's the cross-asset team thinking about these questions today?
Yeah, you're right, Ken. Thanks. That's the key question for us is how much further can we go given the pace of the current recovery? If you're with us on page 2, on this chart, you can see exactly what Ken was just describing, meaning different financial shocks, the peak to bottom downturn in terms of global equities, and the dark blue rectangle showing the recovery in the 2 months that followed the bottom of the market. And currently, the COVID shock is actually, say, comparable to 01 and 08 in terms of magnitude, even though slightly smaller. But what makes it unique is the pace of the recovery that reflects basically the factor you're mentioning, meaning the monetary and the fiscal stimulus, and raising the question, how much further can we go? And our opinion is that we're expecting a continuation in this rally, basically because we are seeing 3 key turning points now, one in the macro space, one in the sentiment space, and finally one in the valuation space. And if you'd like to go on page 3, we will start with the macro turning point. The first question, the first element of answer to your question, Ken, sits in the macro space. On this chart, what you can see is a very interesting message. In red, light red and dark red, you can see clearly that currently macro conditions are bad. The dark red shows the daily evolution of the consensus forecast for economists for the 2020 world GDP growth. And very clearly, you see that this number has been strongly revised down from +3 to -3. This is unsurprising. This goes hand in hand with this light red line that you're seeing, which shows the evolution of a world growth forecaster, which basically says when you're looking at the macro data, you see also the significant deterioration in macro condition, and the similarity of the path of the 2 lines is very striking. So macro conditions are bad. Is this information relevant in terms of asset allocation? We don't think so. What we think is that what matters is the direction now of macro conditions. You see the stabilization phase at the end of the red curves. What we're currently looking at is what's happening with this blue curve. The blue curve shows another indicator that we call the World Growth Newscaster, which shows an aggregation of media-based news flow turned into a growth indicator. And you can clearly see the pickup in the indicator since late March to today. This is the first sign of a rapid recovery, and we expect actually more from that. What's very important to understand is historically, when past the macro bottom, basically when we can say the worst is behind us, usually growth assets have had a tendency to recover. That's the first element to why do we see more coming from equities. And we think that if it's been working historically today is actually no different. But in spite of improvement, of course, in macro and the swift recovery, all is not rosy.
Yeah, I think that's an excellent point, Florian. If we go to the next slide, we can start to see how the participation in the rally has been uneven from multiple perspectives, and this is really what motivates our sort of second key turning point. So this first slide considers the participation from an asset class perspective. So obviously, Florian and Ken earlier were talking about the recovery in equities, but it's also important to look across assets, look to see what else is going on in the rest of financial markets, and see if things make sense. And so what we're showing here is the performance of a couple of our macro baskets, our growth basket and our recession and market stress baskets. These macro baskets are intended to be, simple, logical basket of assets that have, key exposures, key drivers from macro factors. So very simply, our growth basket consists of equities and high yield credit spreads. Our recession and market stress, we've got a mixture of global treasuries, VIX, TED spreads, yen versus Aussie dollar. And so that's really capturing a sort of a hedging type basket. And what you can see here in blue is the performance of the growth basket. Obviously, we had that big sell-off in February and early March, and now the recovery that we've talked about already. The interesting thing is, if we look at the red line, if we look at the recession and market stress basket, what we see is, again, not surprisingly, those assets performed very well during the coronavirus shock. And despite the rally we've seen in equities and to an extent credit spreads as well, this hedging basket, these safe assets, have yet to really retrace back to really where they were before. So when we look beyond just equities and credit spreads, what we see is investors still holding on to those safe haven assets, still from this metric expressing a cautious or potentially bearish view. If we go to the next slide, I'll let Ken jump in here.
Yeah, sure. Thanks, Salman. So maybe the rally wasn't especially broad-based from an asset class perspective, but clearly equity markets were up strongly.
Yeah, that's right. But what we think, again, the perspective is why do we think there is more to come from equities? And on page 5, you can see the second argument in terms of sentiment. Salman explained how concentrated in terms of risk premia this rally has been. This slide shows the same thing, but at a stock level in the stock market. The blue line shows the 200-day return on S&P, so basically the performance of equities. You see the massive recovery. It's quite obvious from the chart. And alongside, you see the light blue line. And this light blue line shows a breadth indicator, a participation indicator. Basically, what the percentage of stock closing above their 200 days moving average. And the gap between the dark blue and the light blue is very big, actually. It's the biggest gap we've seen in 10 years now. This indicates that this rally has been actually very concentrated in a few number of stocks, very precise number of stocks, actually. What we expect now with the macro improvement is that this rally could broaden, meaning that the participation rate in this rally should increase progressively. So this rally has such a limited number of asset classes, as Salman was explaining, and a limited number of stocks. And we think that this concentration element is essential to understand why the current rally could continue.
Got it. So concentrated rally, both in terms of individual equities and in terms of risk premia. What about the number and types of investors participating in the rally? Anything worth noting there?
Yeah, so this is, I think, another place where we see participation lacking. Slide 6 here just very briefly shows a couple of the indicators we look at as a proxy for the positioning of different types of key investors. So here what we're looking at is for equity long short hedge funds, macro hedge funds, and CTA or trend followers, right? So you've got here the sort of fast money, however you want to sort of describe them, but sort of these different hedge fund strategies. And the proxy that we use to understand their positioning, since obviously we don't have, can't see their actual portfolios, but what we do is look at the realized beta of these strategies to different assets. In this case, we're looking at their beta to global equities to essentially see how are they exposed. If equities are rallying and these funds are going down, it stands to reason that they're short equities, just very simply, right? Sort of quick cut-through measure. And when we look at these implied or realized beta, what we see is quite striking towards the end of the chart there. As you can see, both CTAs and macro hedge funds at the end of May look to have been short equities. CTAs more than macro hedge funds, but still short equities. Also, equity long short funds, while still maintaining a bias towards equities, were, from a historical perspective, had much lower exposure than they would in the past. And you can see that also in the table on the top right, where we're sort of highlighting the numbers at the end of the month. I've talked about macro and CTAs being short, about negative 0.1 beta for macro and about minus 0.3 beta for CTAs. But then if we look at the Z-score over the full history, what we can see is really, we're looking at somewhere between a minus 1.5 to minus 1 Z type position at the end of May. Obviously, these investors are quick to change. They also manage a lot of AUM, and when they move and they move quickly, they can really move shift prices around. And so for us, this defensive positioning on the part of these investors gives space for the rally to continue, another leg, as these investors move more positive, either from markets continuing to go up for trend followers, or as the economy looks to recover, and you have macro hedge funds shifting their views. What we'd expect is these guys to come back into the market, start buying equities, credit, et cetera, broadly risky assets, and that would help to lift markets higher. And so this really, we think, provides a potential second wind or second leg to the rally.
Florian, let's get back to you for a moment. You mentioned earlier that valuations aren't quite as expensive as one might think. Can you elaborate on that a bit?
Yeah, of course. It's a very key element of our investment policy. If you've been looking at the recent evolution of forward-looking PEs, you could be under the impression that they are high, which implies basically that equities are expensive to very expensive. We think that we need to nuance this thing, and there are two key elements to do so. Let me just walk you through the first element. The first element is on page 7. On page 7, you can see our valuation indicators. These valuation indicators are currently placing most growth assets in a cheap territory. Why is that, basically? Because we've seen a very strong rally, and this should imply to some extent that they are becoming more and more expensive. Actually, our valuation indicator is based on two key dimensions. When you're looking at PE through time, you're actually doing time series valuation. And time series valuation is only one dimension of valuation. There is another element, which is what we call cross-sectional valuation. And this cross-sectional valuation actually compares the expensiveness of risk premia. That means that when everything is expensive or looks expensive, actually you can make a difference between what's very expensive and what's less expensive. What's very expensive these days is actually hedging assets, bonds, inflation break-evens, and energy and industrial metals. Compared to them, actually, equities look a lot better. That's the first element. The second element is, of course, the large impact of the lower rates now, but maybe Salman, you can walk us through that.
Yeah. So if we can go to the next slide, we can zoom in on what we show here on slide 8 in terms of U.S. equities. obviously, a similar picture holds for other equity markets as well. And so what we're doing here in orange is just looking at the classic valuation metric PE, or as shown here, the its twin, the earnings yield, and comparing that to very simply the 10-year bond yield, right? At the end of the day, many investors have to make the trade-off between investing in equities or investing in bonds at a high level, right? What we can see pretty clearly is if we look at the orange line, yes, earnings yields are low relative to their history. This is the point Florian was making earlier, that assets, risk premia are expensive today. But when we then compare to alternatives that investors have, equities, credit, don't look nearly as expensive. Now, you can see that as, in the gap you see between the blue line, which is the 10-year yield, and the orange line, the earnings yield. Now, obviously, much of this is being driven by a non-economic actor in the Fed or other central banks. They're pushing down bond yields for good reason, but investors at the end of the day have to make this trade-off. And when bond yields are this low, one would expect earnings yields to come further down, or to put it another way, PEs to go up, suggesting that valuations are not as unattractive as they might appear if you look from a purely historical perspective.
Okay, so far we've covered 3 turning points: macro improving, participation having more upside ahead, and valuations not being as bad as some people might think, which all beg the question, how is the team turning these observations into actual allocation decisions today?
That's what you have on page 9. You can see what you were just mentioning, Ken, with the macro turning point, the sentiment turning point, and the valuation turning point. And from that, we get 4 key convictions. I'm going to start with the conviction we've been having now for 2 months, and then ending with what's new in our investment policy. Already last month, we were bearish with real assets. For now, we fail at seeing large inflation pressures, and as we mentioned, the valuation of many of these inflation assets is actually very expensive. So we keep this bearish view for real assets for the time being. Now, 2 positives. Last month, we already mentioned this bias we had for quality growth equities, namely NASDAQ and SMI futures. We like these indices because they've been showing a strong resilience during the macro shock and could beneficiate from the improvement on the sentiment front that Salman was mentioning. So this case basically remains intact. Another case that remains intact is what's happening with emerging equities. We still like emerging equities. We think that they should profit from this improving sentiment situation while showing low valuations still for now in spite of the rally. Here again, we are overweight emerging equities broadly. What's new this month is that we have a broad overweight for developed equities. And I think the audience would have understood why. Basically, we see a macro recovery. That's the first element. The worst is behind us in terms of macro. Second element, with the strong central bank support, the fiscal policy, all of that is also very positive for these equities. And finally, when you're looking at carry from a cross-sectional perspective, they remain attractive, actually more attractive than bonds themselves. So we have there an overweight, a global overweight for developed equities.
Thanks for walking us through those, Florian. Let's get to some of the questions we have coming in. Your views seem positive in light of recent forecasts from the Fed. How do you reconcile the two? And do you still expect a V-shaped recovery?
Let me take this one maybe. Last Wednesday, the Fed made actually very clear that it was still seeing some downside risk. In the macro forecast that were published back then, the message is they do not see a full recovery across the next 2 years. This has, to some extent, surprised markets because it's, to some extent, a very bearish view. We disagree with this perspective. We're still expecting a V-shaped recovery. Of course, the second leg of the V cannot be as vertical as the first one, of course. But there are two key reasons why we're currently still expecting this V-shaped recovery. The first one is, of course, as you've mentioned already during this webinar, the fiscal stimulation, the monetary stimulus, also combined together, must be a supporting factor for the macro situation overall, and that will pay off. That's the first element. The second element is we're basically watching very carefully what's happening on the macro front. I mentioned the newscaster indicator, that is this very high frequency indicator we're using to try to trace back what's currently happening on the macro front. Now, if you look at the world growth newscaster these days, you would see signs, genuine signs of improvement. Let me just give you one figure. At the end of the month of April, we've had about 25% of improving data across 1,000 data we're using for our newscasters. 25%, 25, which is a very low number historically. Currently, this number is 57%. As of today, it's 57% of improving data. So you see the massive turn in the direction of the macro data. This is one of the key signposts we're looking for to validate this V-shaped recovery. So for now, our answer is the Fed is just being a risk manager of the macro and markets in the meantime. It can't really say everything's fine. Everybody would be very surprised with that, and they are acting as a risk manager. That's not our position. That's not our role. And we are still expecting a V-shaped recovery on our end.
Okay, here's another high-level related question. How would a second wave of the virus affect the scenario you guys have laid out?
Yeah, so I can take that one. So I would say definitely that a second wave of the coronavirus is definitely a key risk for our scenario. In particular, if we have a second wave of lockdowns, they'd be real killer to our positive view. However, at this point, we still assign a moderately low probability to this event for a few reasons. The first is that there are still travel limitations in place across many countries that should limit the spreading of the virus from essentially local outbreaks to a more global spread. Two, obviously, we've seen the news lately. There's been a pickup in cases, but importantly, these remain, from our perspective, concentrated in a few regions or states, in the case of the U.S., and so far aren't yet at a pace that would suggest that wholesale lockdowns are necessary, right? And that's very important to keep in mind. We can have these outbursts or small outbreaks, but so long as those outbreaks are not so significant that they will put pressure on hospital capacity, the ability of those local authorities to deal with those viruses, if they're not hitting those capacities, it is unlikely that they would trigger a lockdown and hence another down leg in the macroeconomy. The third point, and I think this is also an important one to keep in mind, is that governments, policymakers have to make a trade-off between the health of their citizens and the health of their economy. And they spent much of March and April and into May really focusing on the health of their citizens, which obviously made a lot of sense at that time. But they've also now shown pretty clearly that they are reassessing how they're balancing those two things and are shifting more and more towards promoting or ensuring the health of their economy. What that means to us is that when you have potential outbreaks, what we think we're more likely to see are tailored measures, are surgical measures, very targeted to what is going on in that community. So, for example, that could mean mandatory masks for some regions. It could mean contact tracing. It could mean isolation. We think we're more likely to see those types of responses to potential outbreaks than a wholesale shutting down of a state or a country. And then I think the fourth point here is, the places where we've seen the pickup lately, especially I think in the U.S. They're also some of the ones who are either late to the lockdowns or very quick to reopen. So it's not all that surprising that they're seeing a pickup in cases. Importantly, though, and this is worth mentioning, that is, as I said before, a important key risk to our scenario. It's not part of our core scenario. And so when we have these situations, our preference for dealing with them is to essentially use optional structures, other solutions to essentially hedge that tail risk. And we're doing that. We've been doing that since the beginning of the month, really. And what we're essentially doing is we've purchased downside protection for our portfolios via convex optional structures. In case we're wrong, these should really help to benefit us and to really protect us from taking on too heavy losses, given that our core scenario is fairly positive.
Makes sense. Getting to some more specific questions, beyond the quality growth bias you mentioned for equities, are there any specific sectors or countries that you guys see as opportunities in the near term?
Yeah. So I think we've sort of have mentioned it to an extent, but I think just to make this clear, this broadening of the rally from a concentrated one to a more broader one within equities and within asset classes more broadly, we think that should be very favorable to laggards and those with depressed valuations. And for us, financials, particularly in the U.S., we think are especially attractive from this angle. They've been laggards in terms of year-to-date performance, and if we're right on our core scenario that the macro picture is improving, we should have a bit of a reflation story going on, and that the potential steepening of the yield curve should benefit financials quite nicely. They also benefit, we think, from the central bank support that will lower the risk of defaults on their balance sheets. So when we combine that with that they remain one of the least loved sectors across the hedge fund industry, we think it's a nice way, a particularly good way of playing our core scenario.
Okay, so speaking of laggards, and we have a few questions coming in around this topic, value has clearly lagged dramatically for some time now. So are you saying that we have a positive view on value moving forward?
Let me take this one maybe. Starting from the idea of the triple concentration, rally being concentrated in terms of risk premia, stocks, and investors' participation, the broadening of the rally will or should beneficiate to value stocks. We've worked actually quite a bit on the macro sensitivities of value stocks, and basically the outcome of our study shows that the current situation could be beneficial to value stocks. The first element is that the value stocks are cheap to some extent from a cross-sectional and time series perspective. Overall, that's the first element, the cheapness of the equity style, if you'd like. The second element is that historically value does well when market stress goes down, which is what's happening currently in financial markets with the retracement of volatility and credit spreads. The third element is that inflation is not a negative factor. Low inflation is not a negative factor for value stocks. The only missing piece of the puzzle is a confirmation of the recovery. Usually, value stocks historically have recovered largely during recovery periods, and we need a confirmation that, like we were saying, the worst is behind us for value stock to profit a bit more from this recovery.
Got it. I think time for one final question. How much of what the newscasters are capturing is sentiment around the virus versus sentiment around the underlying economy? And is it even possible to untangle the two?
I'll take this one. So look, untangling the virus and the economy it's difficult. But our perspective, the perspective we take, is squarely on what is going on with the economy and how that impacts financial markets. So the virus is one factor. Granted, obviously, it's one of the most important factors today impacting the economy. But the way our newscasters are constructed is really carefully done to just pick up the news on the underlying economy, no matter what particular factor may be impacting. Or to put it another way, it's picking up on whatever the media at large thinks is most impactful or newsworthy for the economy. So the newscaster it's not seeking out stories about the virus, but it's naturally picking it up because the virus is so important for the underlying economy today. This then can lead to trading in our strategies as we adjust our exposures based on these signals. And once the virus passes and attention focuses on another driver, the newscaster should pick that up as well and adjust our strategies accordingly.
Got it. Well, that's all the time we have for today. I'd like to thank Florian and Simon for their insights, and also to everybody for dialing in. You'll receive a brief survey immediately after the webinar is over. We encourage you to submit your feedback so that we can take it into account for future webinars. And I'll reiterate, please don't hesitate to reach out to us with any additional questions, or if you'd like to discuss our views with Florian and Simon in more detail. Other than that, stay safe, and we hope to see you again at our next Macro Views webinar.
Thanks, bye.
Thank you. Bye-bye.